you've made a big shift in your policy approach. You know, you're one of the leading, most aggressive central banks when rates had to be turned around and hiked mightily. In July, you made a very dramatic, dovish move, right? And in the meeting yesterday, one of the big questions coming out, and you know you were asked about it in Parliament, is this increase in, you raised the OCR track, the official cash rate track, 25 basis points to 2.25%. And markets now, I think, are trying to figure out what the message is here. How are they supposed to interpret this? Beyond the fact saying maybe it's a technical move, I mean, it is something that people think suggests maybe another nuance here in how the RBNZ is approaching things.
Yeah, thank you, Kathleen, and it's great to be back again. I would say to the markets, be confident that we have time to watch, worry and wait with where the interest rate levels are now. The forward track that you talked about is a projection. It's not us trying to provide a signal or constraint. The projection really reflects that over recent months we've had some outturns on economic activity, inflation. Some of the pressures have been slightly stronger than what we thought, but you know, it will come out in the wash. What have we done? We've got an official cash rate projection 2 years out that deviates very little from 5.50%, and we think that that nicely balances the risks. The near-term risks to the upside on inflation and growth versus the more medium-term downside risks to inflation.
Well, so is it fair to say that at the this sort of opens the door a little wider to another rate hike, for example, if it proves to be needed? In other words, what you're saying is you're not trying to signal anything, but in terms of making this small shift, but certainly noticed by everybody, does it at least do that for you? If you do have to do something to bring down inflation, even if it's just a little bit more.
That's right. I mean, you know, the important thing is we never say never. Monetary policy is a repeat game. We get new information, we reassess the outlook, and then we reassess our stance. So, you know, a straight line could be read as exact forward guidance. We can't provide that exact forward guidance because there is always too many uncertainties that we need to manage and retain that optionality. At the moment, you know, the near-term risks are to upside inflation, i.e. inflation proving to be more sticky, a global phenomenon. Output growth, particularly with the strong net inward migration into the country, could prove stronger than what we have, you know, for the next 1 to 2 quarters ahead. But we're very confident over the horizon that matters for us, 1 to 2 years ahead, that we are being restrictive with monetary policy and in a position where we could tighten or loosen as needed based as the information unfolds.
But it seems like at this point, let me ask you this. Core inflation is still high, and that's one of the things you have pointed out. Is it fair to say that right now you still see more of an upside risk, especially in the medium term, to inflation, given that core inflation has stayed high, the headline has come down slowly, then you would see the risk of lower than expected inflation? Again, you can always have all options on the table, but sometimes the option on the table is a bigger, more important option than all the rest.
Yeah, I do truly believe we have a balanced forecast ahead for the OCR based on what we see. I don't see the balance of risks either more up or more down. The more challenging part for us is the risks near term and more medium term. It's the medium term risks that win the day because that's what we can influence, but we have to be robust around what we can expect to see over the next couple of quarters. I don't want to suddenly spook ourselves because growth might have turned out slightly stronger than expected or inflation more persistent. There's nothing that we can do to manage that over the next 1 to 2 quarters ahead. Instead, we have to stay focused on the medium term. So that's what that is signalling, you know, that we believe if we stay where we are for long enough, inflation will be back inside the target band mid next year and stay there. But, you know, there, as always, there will be risks.
Governor, it's Paul Allen here in Sydney. I just want to ask you about the New Zealand dollar. I'm not inviting you to comment directly on the currency, but it is very weak at the moment, mostly due to forces beyond your control, of course. But do you see an inflation risk coming from this weak currency?
Yeah, so with, it's kind of all currencies are weak. The US was strong, I think is the story. But the real challenge there is not just where the exchange rate is or where it went, but why is it there and what's it reflecting? So, on the view of weaker global commodity prices and a more narrow interest rate margin, we can comfortably explain where the level of the exchange rate is at the moment. It's not unusual given the economic drivers that are there. Whether it's inflationary or not really depends on what is the weaker exchange rate reflecting. Is it reflecting weaker global earnings because of commodity prices or some kind of portfolio shift? So it's not as simple as just looking at the level and thinking, oh, is that inflationary or not? It's more about what are the drivers underneath. For our projections, we deliberately just provide a straight line from where the exchange rate currently is. And then every quarter when we're looking at our monetary policy, we ask, can we explain where the exchange rate is and is that inflationary or not over the horizon that matters?
Now, there is, of course, an election coming up in October, and again, I'm not inviting you to comment on politics. I know we want to keep church and state separate here, but I'm sure the Reserve Bank must be cognizant that the fiscal environment could be changing. What are you thinking about in terms of those potential scenarios?
Yeah, so, the government expenditure is a big part of any economy. And at the moment, we deliberately and always will use the official projections from the government of the day, which is the budget 2023, for the numbers we have. In that, our forecasts are very dependent on the budget activity occurring as projected. And that is one where there is some near-term increase, upward pressure on inflation, and then over the medium term it is tailing off as the government shows fiscal restraint. Any deviations from that will be important to us around that balance of risks to the inflation. The fact that the government is shrinking as a share of the total economy provides us less concern around the inflation environment.
Governor, you are, the RBN says forecasting recession coming up pretty quickly. If the economy, New Zealand economy, is clearly dipping into recession, into something that is even a mild contraction, will that be enough to start cutting rates?
It's the bare minimum we need to see because, without doubt, demand has been well outstripping the pace of the supply capacity of the New Zealand economy. This is why we are constraining spending through the high interest rates. We need to see subdued consumer spending, business investment, and government constraints on spending. These are a critical part of the inflation process moving through. One swallow won't make a spring. We'll have to observe the persistence of that slowdown to give us the confidence we're on path to achieve our inflation target.
Well, and that's I'm glad you touched on that, because how are you going to prioritize the need to start giving the economy more stimulus against the need to reach your inflation target?
Yeah, so, it's far too early to talk about more stimulus at this point. We need to see a continued level of economic activity being below the potential growth rate of the economy for a while. Now, it's the level of activity rather than the growth rates in these activities that matter for us. So, we talk about recession, but, we're basically saying about the same level of economic activity, continued strong labour market, employment growth. That's a great combination at the same time if we're also achieving disinflation.
Governor, a lot of central banks, or some anyway, are talking more. They're kind of seeing the end of their rate hikes, but they're talking a lot about higher for longer. Are you in that higher for longer camp?
Yes, I think we've been sitting there for quite some time now. You know, we were, as you mentioned earlier in the intro, we were quick to the chase on tightening rates. We've got to this restrictive level, and we're in no rush to be, we don't feel a rush to be needing to be changing rates for any time soon.
So one more big picture question, because again, I started by saying how quick and aggressive the RBNZ was to lead the world in rate hikes, even bigger rate hikes. And even so, even you know, for inflation fighting wars like you, inflation got out of control. What lesson learned for central banks from this episode? What is it?
I think the real critical lesson is that the supply capacity of the economy matters as much as monitoring demand. And the supply side of the global economy shrunk beyond any expectation through COVID. Then it shrunk again with the invasion of the Ukraine. And then we've had our own idiosyncratic severe weather events. These have all impacted the supply side of the economy. We can only influence the demand side. We have to, so you know, a lot of our work now is about how can we get a really good handle on the supply capacity of the economy to really have the full picture in front of us when we're working out what is excess demand or not.